FR. NDAs and presentation and disclosure. Enter principle of financial statement. Navia Limited is manufacturing ceramic tiles and shows net profit of 15 lakhs in the first quarter. Okay. Following an adjustment made in the profit. Bad debts 1 crore 64 lakh 1 lakh 65,000 and 70% of the bad debts are deferred in the next 3 years 25% okay. So இதில் வந்து 25% இந்த வருஷம் 70% being deferred in the next 3 quarters. அதாவது next 3 quarters தான். Okay. Sales promotion expenses 5 lakhs incurred in the first quarters and 90% expenses different 30% of each quarter. Additional to 30 lakh resulting from the change in method of depreciation being taken into consideration. Okay. Extraordinary loss 1,36,000 incurred during the quarter has been fully recognized in this quarter. Okay. Discuss the treatment of recommended in DS 34. Ascertain the correct net profit to be in the interim financial report. In the first quarter to be presented in the board statement. In the instant case, the quarterly net profit is not being correctly stated. So in DE's interim financial reporting, quarter of net profit adjusted restated. The bad debt 64 lakhs out of 75 percentage incurred during the current quarter. Out of the company's default 70% is 1 lakh 53,000 the next 3 quarters. The treatment is not correct, and the expenses incurred during the interim reporting should be recognized as the same period unless condition mentioned there were certain end of NDA 34. Accordingly, 1 lakh 34 should be deducted from 15 lakhs should be deducted super. And is 34 income and expenses should be recognized when the earned and incurred respectively. India 39, para 39 of India 34, cost should be anticipated and deferred only when appropriate to anticipate the defer the terms of cost at the end of the financial year. The cost of the incurred unevenly during the financial year. Therefore, the treatment done relating to defer 4 lakh 50,000 90% is not correct as expenditure is uniform throughout the all quarters. It should be charged to the quarter in respect of this income. Hence, it should be charged the charged in the first quarter only. Okay. So recognize of additional depreciation in the same quarter is correct and tuned 34. The treatment of extraordinary loss or reverse during the recognized in the same quarter is correct. So condition considering the above corrections, that should be this should be in the interim report 9 lakh 115 lakhs minus 4 lakh 50,000. That is the cost minus 1 lakh 23,000. This bad debts. So 9 lakh 27,000 as a profit. Okay. Following are the financial statement as per the JSP Limited. Following on the JSP Limited, what is it? The equity capital 20 crores. Reserve surplus 25 crores. Long-term borrowings for 48 crores 60 lakhs. Deferred tax 1 crore. Trade payable 4 crores. Short-term provision 3.3 crores 10 lakhs. And other current liability 2.2 crores 50 lakhs. Total 104 crores 20 lakhs. Current liability plant 56 crores. Deferred tax asset 3 crores. Inventory 15 crores 20 lakhs. Trade and receivable 18 crores. Cash and cash equivalent 12 crores. So 104 20. Okay. Statement of profit and loss account revenue 75 crores, employee benefit was 17 crores 15 lakhs, operation cost 28 crores 60 lakhs, depreciation 8 crores, total expense 54, profit and loss, tax expenses minus, okay. Notes to account capital reserve minus opening balance plus opening balance minus plus addition 1.8, reserves and foreseeable loss 2 point, so 1 2 3 add number 2.8. Long-term borrowings 4,850 super. Deferred tax asset 300 minus 100 200. Current liability unclaimed dividend billing in advance 240. And trade receivable considered good 5. Considered doubtful pass 253. Considered provision doubts provision 18 so 1,800. Share capital comprises of 200 lakhs of 10. Term loan from the bank is 4,860, also including the interest and account due to 860 lakhs on the reporting date. Reserves of foreseeable losses create against service cost due to 3 months. Okay. Identify the report the errors and mistakes in the above and whichever is applicable. Report the correct balance sheet. Okay. Analysis of the financial statement. The reserves and foreseeable losses to 95 lakhs due to 3 months should be part of provision. Hence, it should need be regrouped and it would be previous year comparison. Note should be added the note of accounts regrouping to this year. Interest accrued due to 860 lakhs in short-term loan will be part of the current liability. Hence, it should be shown on the other liability heading. It can be informed from a note. It is a deferred tax liability. It's a to tax and income laid the same governing tax. Hence, it would be set off on section 90 A22, A22. And net DTA 200 lakhs should be shown on the balance sheet. Notes of trade receivable incorrectly presented. The trade receivable over 6 months considered good, considered doubtful, 0. Provision 18 lakhs, 235. Others then consider as good. இப்படி கொடுக்கணும் trade receivable unsecured unsecured. Statement of profit and loss account need to represent earning per share based revised extract of the balance sheet. Share capital 20, share result 22, current borrowings, trade payable, short-term provisions, beyond 20 inventory, 700 employee benefit expenses, other operating costs, depreciation, tax before profit, profit of the period, earning per share, diluted, deployed, notes to accounts ever applied. 400, opening balance 200, addition 1850, so 2250, long-term borrowing 4000, unclaimed dividend 10, interest on term loans should be current liability, and this is it. Okay. No, sure, okay. Mike Limited is undertaking the following various transactions in financial year. Reimbursement of deferred benefit plans 1,50,000, current service cost 1 lakh, change in revaluation surplus 75,000, gain and loss occurs due to translation of money assets in the foreign currency 45,000. Gain and loss arising in translation of financial statement in the foreign operation 39,000. Okay, gain and loss arising in investment in the equity instrument designed to fair value through other component income 60,000. Income tax expenses 21,000. Share based payment cost 201. 201,000. Identify present transaction financial statement as per India is one. Okay, item impacting statement of profit and loss account இதெல்லாம் service cost, money foreign assets, operations அதை அப்ளை பண்ணோம். Income tax expenses, so service cost 1 lakh, foreign gain asset money 45,000, income tax expense 21,000, share based payment cost 101. Okay. Item impacting comprehensive income வந்து remeasurement defined benefit, change in valuation 70,000, gain on loss in the translation of finances to foreign asset 39,000, and gain on loss of investment and designated fair value through other component income 60,000. Okay. From follow the financial statement of Abraham Limited, equity, share capital, reserves and surplus, long-term borrowing, deferred tax, trade payable, short-term provisions, PPE, deferred tax, inventory, trade receivables, revenue from operations, employee benefit, total expenses, total benefit, everything. Accounts, P&L, by additional loan from bank, deferred tax asset, deferred tax liability, அதர் கரண்ட் லைபிலிட்டியில் அன்கிளைம் டிவிடெண்ட் இருக்குது, பில் இன் அட்வான்ஸ் இருக்குது, அதர் கரண்ட் லைபிலிட்டி இருக்குது, ட்ரேட் ரிசீவபிள் இது ரிசீவபிள் தப்பு கொடுத்துருக்கான். So share capital comprised of 100 lakhs of 10 long-term loan from the bank 7 lakh, 5,700 lakhs including the interest accrued 700 lakhs responded. So other current liability காட்டணும். Reserves and reserve from foreseeable loss created against the reserves contract due to 6 months. Okay. Inventory has been valued at cost 1,500 lakhs. Net result value is 1,200 தான் காட்டணும். Dividend 10% declared by the board, liability காட்டணும். Accrued income 300 lakhs is not booked. Accrued income காட்டணும், accrued expense போடணும் போதும். Income accrued 0 போடலாம். சரி, ஓகே. Deferred tax rate 2. Identify the report error mistakes in above extract and prepare the current balance sheet P&L. Okay. On valuation of financial statement following observe aforesaid loss provided it's made and not relevant or not reserved. Hence the reserve foreseeable loss 400 due to 6 months should be part of provision. Therefore need to be regrouped. It should be part of the previous year comparison and the note should be added to the note in accounts of the regrouping done this year. Interest accrued due 700 lakhs in the term loans will be a part of current liability since the supporting to be paid in 12 months. So current liability as per India's inventory measured in the lower cost and net realizable value whichever is lowest. The amount of written down of inventory to be realizable value is recognized in the expense in the period of written down books. and the inventory should be valued at 1,200 lakhs and return value 300 lakhs. So 300 lakhs should be reduced. Added to the operation cost of the entity in the absence declaration of the date of dividend. The question is present the dividend is declared after the reporting date, hence no adjustment made since the fiscal year 1819. And therefore, the note should be given separately into that. Accrued income will be shown in the statement of profit and loss account, other income, other current asset and liability. Since the deferred tax liability and deferred tax asset should be related to tax and income levied on the same governing tax laws, these shall be set up accordance with the Ind AS 12. Net DTA of 300 lakhs will be shown in the balance sheet. As per the Division 2, Schedule 3 of the Company Act 2013, the profit and loss account should be presented in the earning per equity share. Okay, okay. And the India's assets will be present, not present in the balance sheet as fixed as PPE rather than classified under the various categories, non-current asset and plant and property equipment. The firm presented in notes trade receivable will be notified in required Division 2, Schedule 3. Balance sheet, PPE, plant and property equipment, deferred assets, inventory 1,200 குறைச்சு போடணும், trade receivable 1,200, cash and cash equivalent, other current accrued income interest போட்டுக்கணும். Receivable na equity 100 lakhs, other equity 200, financial borrow 5 lakhs, trade receivable, trade payable, short term provisions add பண்ணிக்கணும். Okay, revenue from operation, other income 300 and operation cost 339, change in inventory cost 300 அங்கேருந்து போடணும். The employees benefit expenses 1,200, depreciation 450. Okay, tax expenses basic deferred tax asset is equal to deferred tax asset divided liability. Asset and liability 300 asset போயிடும். Trade receivable வந்து right receivable considered good 164, trade receivable significant risk 40, provision வந்து 40, so ரெண்டு சேர்த்தா 35, so 1 இதையும் கழிச்சு ஆட் பண்ணோம்னா 105. Increase in credit risk capital வந்து 1,000. Other equity போட்டோம்னா during the beginning of the year 500, retained earning 550, total 110, total comprehensive income 950, so total 2,000 வந்து லாங் டேர்ம் பாரோவிங்கு 500ல இது முடிஞ்சிடும், ஏன்னா இன்ட்ரெஸ்ட்டில் 5,000 மட்டும்தான் உட்காரும். அன்கிளைம்டு டிவிடெண்ட் 10, இன்ட்ரெஸ்ட் நம்ம லோன் 700, அங்கேருந்து ஃபினான்ஷியல் லைபிலிட்டிக்கு வந்துடும். ஷார்ட் டேர்ம் ப்ரொவிஷன் 300, foreseeable loss due to service contract 400, அதர் கரண்ட் liability 150 and others 40. Dividends not recognized, and in the year end the director has recommended the payment of dividend of 10%, 1 per equity share. The proposed dividend is subject to the approval of shareholders and ensure the annual general meeting. First April, Star Limited has advanced the housing loan of 15 lakhs to one of the employees at the interest of 6% per annum. The repay in 5 equal annual installment along with the interest each year. Employees not required to give a specific performance against a benefit. Market rate of the similar loan is 10% per annum. The account of the company recognized staff loan, the balance sheet equal to so 15 lakhs, and interest income is recognized in the contracting state of profit and loss account 90,000, 6%, 15 lakhs per annum. So analyzing the above account statement made by the account compliance with the NDAs, it does not advise the correct treatment of housing loan interest and expenses. Okay, you are required to explain the housing loan is deferred in the NDAs compliance balance sheet. In the given details, account of Star has recognized the staff loan in the balance of 115 lakhs. In this account disposed and 90,000 interest income for the period of recognized at the contracting rate. As is incorrect, is also not accordance with the provision of Ind AS 109. As per the provision of the above state, staff advance should be financial assets shall be initially measured at the fair value of subsequent amortized cost. That is payment. Interest rate is calculated at the effective interest. This difference between the amount of lent and fair value charged. So in this case, on the cash flow, this is a very good thing. This is a very good thing. So what is thing is? Cash flow 10 percentage is the cash flow. They have given around not 3 lakhs, 15 lakhs. Mm, calculation of amortized loan. First working not one. Mm, so 15, 19, 3 lakh 90,000. 3 lakh 90,000 எப்படி வந்துச்சு? That's a question. So equal amount of pay. How many years he going to pay? 5 installment. So 15 divided by 5 is equal to 3. 3 plus 90,000, 3,90,000. 3,90,000 present value 0.9, 354. அப்புறம் வந்து 3,72,000 because why 3,72,000 is because they had paid this first point. 3 lakhs paid, not 12 lakhs, not 12 lakhs divided by um, 12 lakhsக்கு 6% போட்டோம்னா 72,000 தானே வருது. ஸோ 3,72,000 0.5, 3,54,7, 3,35,8, 3,18,6 எல்லாத்தையும் ஆட் பண்ணோம்னா ப்ரெசன்ட் வேல்யூஸ் 13,50,000. 13,54,02 plus effective interest rate 10 percentage. Cash flow, net cash flow 130%. Net cash flow received is that line. So the cash balance is 11 lakhs. 11 lakhs into 10 percentage per annum minus 372, 8 lakhs. 8 lakhs minus 10, 8 lakhs minus 10% into 10 percentage, 83,000 minus 354 received. So this is balance 357 into 10 percentage minus a cash flow what received, and this is the return, and 288, and this is the figure what we given you. So it's zero. So not current, our loan should be considered as how much a loan should be considered 838.6068 போட்டிருக்கா. The correct presentation on 2021. 21 is 838 lakhs and other current asset loan is 261. Correction presentation, correct presentation to the current asset loan and financial asset loan 281. So employee loan account to profit and loss account to bank of 10 lakhs. Year end bank account 3,90,000, interest to employee benefit cost 254. Okay. Maybe loan 11 lakhs minus இது 261. Then initial entry employee 13 plus 15 lakhs கொடுத்துருக்கும். Then year end bank accountல 3,90,000 வந்திருக்கு. அதில் இன்ட்ரெஸ்ட் 1,35,000 அதை கழிச்சிட்டு மிச்சம் உள்ள அமௌண்ட் 2,50,000 எம்ப்ளாயி காஸ்ட் பெனிஃபிட்டில் போட்டிருக்கு. Entity A has obtained the long-term bank loan during the January, which is subject to certain financial convenants. One of such convenants stated during the tenure of the loan, the debt equity ratio 65-35 has been maintained all time. In the case of the breach of this covenant, the loan has been repayable immediately. The loan agreement also states that as a convenience will be assessed at the time of each quarter, reported to the bank within a month of the end of the each quarter. If the convenience of the breach at the time the loan will be repayable immediately, the entity closes the annual accounts at the market March. You are required to show how the loan would be classified on 31st March. If the financial year end, the entity A determines that it is not a breach of any of the conventions. At the quarter ending, that was when the equity and debt is 75-25. And this breach is the covenant. However, it's obtained the waiver on the bank. The terms of waiver, but entity A activates the breach is 21 months. The reporting date and the bank cannot demand the payment immediately at account of the breach during the period. The entity experts rectify the breach arising additional equity capital of the means of rights issues of the existing shareholders. Except the issue will be fully subscribed. Consider the same fact to accept the obtaining the waiver clause. What will be the answer? So, according to the para 54, the presentation of financial statement where there is a breach of material provision of long-term loans, an arrangement on or before the end of reporting period which affects the liability because payable or demand reporting date, the entity does not classify the liability correct. If the lenders agreed after the reporting period and before the approval of financial statement issue not to demand payment and the consequence of the breach. However, the entity classifies the liability as non-current. It is the lender agreed to end the reporting period to reporting provides a period grace ending at the least of 12 months on the reporting period, within which the entity shall rectify the breach and during the lender cannot demand an immediate repayment. And it has obtained a long-term loan during January. Since the repayment of the loan is not mentioned in the question, it is assumed 31st March. The repayment mode of the loan is 12 months. Further, the entity has not breached the conduct of the law. Therefore, 31st March, and that loan would be classified as a non-current liability. In the second phase, the second phase, when the breach in convent 31st March, and before the reporting 31st March, yet the bank has agreed to provide the period of grace of 12 months from the reporting period within the entity A rectify the breach during the bank cannot demand immediately. The entity intend to rectify the breach, then the entity A is classified with a loan non-current liability at the books on 31st March. Since the covenant of the bank loan has been breached during the end 31st December, they reported to the bank within the 1 month on the end of the quarter, 31st December, the bank loan becomes payable immediately. Thus, it will be present current liability in the books on 31st March 2020. Continue. Visit Limited has a overseas branch in USA. It has a bank account has a balance of $7,000. On 1st April, during the financial year 1990, Isaac acquired a computer from US office at USD $280 and paid the same month on date. And there is no other transaction reported in US India. The exchange rate of the India and USD 1920 was April 70, November 71, March 70, average 70.5. Please prepare a cash flow statement the year of 31st March as per the relevant to India is also show the foreign exchange profitability in the transaction financial year. Okay. Cash flow operation net profit for first opening 7,000, purchase on the 280, closing balance calculated is 2720, and at the end 6720. Good. But this 71 purchase computer was $71. So 71 into 280, $19,000, 4 lakh 70. But as per the values increased point 0.5, this 670 increased to 4 lakh 80,000. So 10,360 is a profit. 10,360 is a gain net profit. Adjustment to the net cash adjustment for gain 10,330. And like cash flow from investing activity, property as property. So we had invest 19,980, zero. And net cash flow equivalent. Cash in cash in beginning of year 4 lakh 90,000. Plus minus 19,000 plus 10,000 4 lakh 80,000 480 is on 30% much. Thank you. The Jam Limited is a manufacturing company which is manufacturing wires and cables and assess the operation cycle is 15 months. Company has come trade receivable which is received within the period of 12 months from the reporting period 31st March, which result in the following transaction when it took place during the financial year. One of the opinion based in the relevant indices. Company has received a contract of 10 crores on 31st March and the terms of the contract require the company to make and secure deposit 20% of the contract value on the customer. The company has made a deposit of 2 crores that US month. The contract has been completed within 14 months. 70% deposit will be refunded immediately. 30% will be refunded 3 months on the completion of the contract. The company want to present the security deposit 2 crores as a non-current. Okay. Okay, because 12 months more is a managing intention correct. The company has some trade receivable due 14 months and in the current month balance on the management of the company expected to receive the amount within the period of operating cycle. Despite the fact that the receivable is 14 months, management would like to present this current non-current, Management decision is correct. In the normal course of business, the company has given two contract and receive a total security deposit of 4 crores. 3 crores received from X Limited, 1 crore from the Y Limited, 31st month. These are repayable on the completion of the contract. However, the contract is cancelled within the contract time of 18 months, then the deposit became payable immediately. The company is positive about the contract X Limited, but is doubt about the contract received Y Limited. Okay, company want to be present the amount 3 crores is a non-current, 1 crore is a current one. Is the management decision is correct? Okay. Company is planning to replace a machinery. It was given the advance of 1 crore for the purchase of new machinery. It will deliver 6 months and the date of the balance sheet. It has sold the old machinery point 5 crores and payment which is due in 10 months. And date of balance sheet is straight receivable. The company wants to present both the amount of the current since it will be settled within 12 months. The end of their voting period, management decisions correct. Okay. Secure deposit company, customer classified the current asset 40% 2 crores. As it is refundable immediately in 14 bill contract, that is operating was 15 months. And 30% security deposit refund 3 months of completion of the contract, so 13 plus for 17 months. After 2 months of the operating cycle, so this is operating cycle of the company is 15 months. It is a trade classified as a non-current. Therefore, the management decision is not correct. So 1.4 could be current and for 2 crores is non-current. Yes, the company decision is correct and presenting the trade receivable as current display because 15 months trade receivable is 14 months because the 15 months is the operating cycle of the company 15 months and the event arising due to the trade will be considered as in current the relevant in the tenure of the operating cycle. Additionally, companies also need to disclose the amount that is receivable within the period of 12 months and after 12 months from the reporting period. Para 1661 of India is one. Para 69D of the India is one state that the entity shall classify the liability of the current when does not want to unconditional right to defer settlement of the liability at least 12 months from the date of reporting period. So although X limit has fulfilled the contract and deposit will not be refunded, but the case of cancellation will be contact them. Refund a deposit condition it is not within the control of the entity. That Sham Limited does not have the unconditional right to defer the settlement of the liability at least 12 months after the reporting period. According to the liability, deposit will be classified as current liability for both the cases. Okay. Yes, the management decisions payment of zero point 0.5 crores is the current asset is correct since the payment will be realized in the lesser 12 months in the reporting period. The capital advances are given by the procurement of machinery. Typically, companies does not expect to realize them in cash, partially rather over the period these get converted into non-current assets. Such a capital advances should be treated as a non-current asset irrespective of the plant property equipment expected to be received. In NDA Schedule 3, the capital advances will not be classified as capital work in progress since they are specifically for disclosed in the non-current other non-current asset. Accordingly, advance 1 crore be given to the purchase of machine as capital advance. It will be classified as a non-current and relating to the acquisition of non-current items, machineries. Hence, its management decisions is classified and the current is not correct. Heavy Limited has a plant with a normal capacity of producing 90,000 units and product per annum. Expected fixed production overhead is 1,80,000. 82. There are no quarter seasonal variation. And the normal expected production of each quarter is uniform. Actual production year period is 87,000. The production details in quarter 1, quarter 2, quarter 3. Calculate allocation of fixed production overhead. All the 4 quarters and will the quarter results affect the annual result? Give the answer in DS 34 and in DS 12. If it is considered there is a no quarter or seasonal variation, there is an normal expected production every quarter 20,000 units. The fixed production overhead is 4,50,000 average water. The fixed production overhead is be allocated per unit on production every quarter 20 per unit. Fixed on quarter one and actual fixed orders to 4,50,000. 4,50,000 இப்படி வந்துச்சு so 18 divided by 4 so 9 to 4.5 4,50,000 the fixed production overhead based on the allocation of it is 20 per unit அது எப்படி வந்துச்சு ம், okay 20,000 okay 20 per unit it is 20 into 20,000 for 40,000 4 lakh but 40,000. Unallocated fixed production overhead to be charged to expense on NDAs 2 and consequently as per para 2. Quarter 2, the annual actual fixed production overhead is 9 lakhs and the fixed production overhead is 20, so 8 lakh 80,000, 20,000. Non-allocated fixed production overhead to be charged to expenses 20,000. The actual production overhead of this year basis 13 lakhs. Actual is 13 lakhs and 4 lakh 50,000. The on the fixed production overhead is to observe is 13 lakh 15,000. The yearly 50,000 and 20,000 are not allocated to production of in quarter one, quarter two respectively. They give effect to the entire 13 lakh 50,000 allocating to the lottery in the is 34. Sound is reversed by way of credit to the statement of profit and loss account quarterly. Quarter four, the actual production overhead of the year is 18 lakhs. Fixed production of the overhead is 18 1 lakh 74,000. So 1 lakh 50,000 minus 20 into 19,000 60,000. Allocated total credits to the quarter four will be expensed off as per the principle of India is 2 and India is 34 by way of charge to the statement of profit and loss account. On account, the cumulative result of this quarter should be result of unallocated overhead 60,000. This meeting the requirement of India is 34. The quarter result should not affect the measure of annual results. Okay, thank you.